What's up guys? Welcome back to the channel. My name is Jackson. In this video, I'm going to make a video talking about the 4 stocks that I am buying in September 2021. If you guys are new to the channel, I like to talk about personal finance, credit cards, coding, and investment strategies, so be sure to hit the like button and the subscribe button to see more content similar to this. So the first stock on my list is Digitalocean. And if you don't know what Digitalocean is, it's a cloud computing solution for enterprise businesses and small businesses. If you're outside of the software development space, you've probably never heard of Digitalocean. The reason why I like it is because it's a big competitor to Amazon Web Services, Google Cloud, and Oracle, along with Azure. And I like it because as a software developer, it is just so much easier to use than any of those platforms. It is a little bit more expensive, so you do have to keep that in mind if you are going to go down this route. But I really just enjoy using the service. It's great for the purposes that I've used it for, and I'll continue to use it for the future. So as an investor, though, let's take a look at some of their holdings. Their balance sheet, you can tell, this is their income statement right now. These numbers here are increasing. So the revenue is actually going up, which is always something that you want to see. They're currently not profitable, so they still are underwater. However, it's going in the right directions. Taking a look at their 1-year chart performance, you can see they IPO'd around in March timeframe, and they've continued to really just go up. I think it was last Friday that they had like a 15% increase in one day. So I think the valuation is getting a little overvalued right now, but I do expect a little bit of a pullback. Overall, I think Digitalocean is a great stock to add to your watch list, wait for a dip, and then buy in if the stock gets low. But I really think that around the $70 price range is a fair market value for it. So if it gets below that, I'll be adding to it. Anything above that, I'm going to hold off and wait. With that being said, let's move on to the next stock. The next stock on the list is Goldman Sachs, and they are a big, one of the major banks in the United States. They assist with credit lending and IPOs and a lot of things that you would expect normal banks to deal with. However, why I like them a lot is because banks will be raising interest rates here in the next few months. And I think that when interest rates start to go up, bank stocks tend to do well. Taking a look at Goldman Sachs financials, you can see that they currently have an earnings per share of $54 and a current PE ratio of 7.5. Now, a lot of this out of context doesn't really mean anything, so let's go and dive into the macro trends. Looking at their quarterly statements, you can see going back to 2018 that their revenue has been increasing pretty substantially every year. So, every quarter, they've reported about a 10% growth on their revenue, which has turned into an operating income that is substantially higher than where it was a couple years ago. Now, again, we expect when rates to go back up, their operating income I think, will go up even more because a lot of what they do is lending out credit. Looking at their price ratios, you can see that yes, their stock is at an all-time high. However, their PE ratio is pretty low relative to where other investors were buying. So if you go back to the mid-2017s, their PE ratio was around 11 to 10, and their stock price was around 212. Now their PE ratio is down in the 7s, and their stock price is at 411. So I could see this really going up to around $600-700 as a price target just to kind of match that PE ratio of where they've been favorably valued. And it's always good to see a company that is buying back its shares. So here we can see that their current shares outstanding every quarter, it's been trailing downwards. So this is good to see that investors and the company itself are still valuing this company and they're still buying back shares. Because if this was going up, that means they would be selling shares in order to stay afloat, which is a huge red sign for investors. Overall, I think Goldman Sachs is a fantastic investment, so I'll be holding a couple shares in Goldman Sachs, but let's move on to the next stock. The next stock on the list is Kroger, and Kroger is a grocery store located in Cincinnati, Ohio. However, they have other subsidiaries like Ralph's. Kroger has really been on an explosive run the last few weeks because Warren Buffett has said he's buying a lot of Kroger stock. Now, if you've been following me on this channel for a while, you know I've been very bullish on Kroger since the 2018 era. So I've been holding around $4,000 of Kroger stock, which is now worth probably around $7,000 because it's appreciated around 50% since then. And so I'm going to go through my analysis again on why I think Kroger is an excellent long-term hold. First, we can go through their PE ratio, and I think their PE ratio is getting a little bit high for grocery stores because grocery stores tend to have very low profit margins. So if you look at what Yahoo is telling us is that it projects that Kroger stock will continue to go up just very slightly, maybe track the S&P for the next few years, and I would certainly agree with that. I would give this a fair value of somewhere around the $70 range. I think if it gets any higher than that, that's going to be considered overvalued. But right now, I think for their current income, it's doing very well. Another good thing that you want to see as an investor is that the company is calculating for more cash on hand. So you can see here that they are definitely continuing to increase their cash price to free cash flow, which is a great sign to know if they get any difficult times that they're able to pay off debts very quickly. Another great thing to see is that their shares outstanding is going down. Like I mentioned with the Goldman Sachs example, you never want to see a company that is selling more shares in order to stay afloat. This is usually a very bad sign. And so when you have a company that is buying back its shares, this is decreasing the shares in existence, which is increasing the value of those shares. Taking a look at their income statement, you can see here that between the 2018s and 19s, their revenue really was pretty stagnant around that 30 to 40,000 range. And then now with the pandemic and everything going on, they've been able to increase this a little bit. But their main bottom dollar is their gross profit. So how much are they making actually after they account for everything? Their net is what we care about. So you can see their net income here is still relatively low. And like I mentioned before, that grocery stores are on the lower end of actually making a profit. So their profit margin is usually only around 1% to 2% after they account for all of their other expenses. But really what I like about Kroger the most is that they really put an emphasis on data. So they do a great job of gathering customer data on what they're buying, what they're purchasing, and making sure that they're always getting coupons, they're downloading the mobile app, and they can build the big data set of all of what their customers are buying so they can go out to suppliers and say there's a market need for this product, and this product. Also, their Kroger brand is very well renowned for how good that it is. I usually only buy Kroger brand products because I just really like the quality of the actual Kroger brand versus name brands. And for the final stock on this list, I'm going with Ford. Now, Ford is an electric vehicle company. I guess they're just a vehicle company, but they've really put an emphasis on focusing on green and electric vehicles. So the reason why I like them is because they're coming out with the Ford Maverick later this year, which is a gasoline or a hybrid truck starting at $20,000. So that's just a great price point. It's a very small, compact car that looks really, really cool. They're also coming out with the Ford Lightning, which is a fully electric truck that gets around 400 miles of range. No other automaker has been doing things like this, which I think is just really cool to see them push forward this innovation. But the coolest thing that I think they're doing is with the Mach-E. This is the Mustang Mach-E. I really like this car. I've actually considered getting one over the Tesla. Also, just because that there's the tax credit that you can still get from buying a Ford. So I imagine that that's going to attract more people to look into the Ford Mach-E when it becomes available later this year. Personally, I just think this car is really, really cool. Ford does need to put an emphasis on building out their infrastructure. So they need to start developing some superchargers to rival Tesla. So right now you can see that their last income or revenue statement was in June. They reported kind of not great results. They are slipping a little bit, but mainly this is due to the chip shortage. So since there is a large emphasis on their cars requiring chips, they are kind of suffering a little bit, but so is every automaker right now. So I would like to see them kind of improve a little bit on that front end, but a lot of that is just supply chain that they don't really have a lot of control over. So their total income after taxes was pretty low compared to where it's been in the last few years. I mean, actually, some of these years they did post a negative, so that is a little more concerning. But I like the direction the company's going, and I think they're going to be a good player in the electric vehicle space moving forward. Their PE ratio right now is getting a little bit high, so it's around that 15-16 range. because their stock price has been up relatively in the last few months, but investors were very comfortable paying around that 10 price range for it. So I would like to see Ford's income go up, but again, this is all kind of stuck on that chip shortage. So I think once that ends and they're able to get more chips into their cars, we will see a lot more demand for their cars because they're just having trouble getting them out the lot because they're just sitting in football stadiums, not being able to be sold because they're missing chips. So I don't really blame a lot of this on Ford's leadership right now. A lot of it is on the chip shortage. Okay, so that's my list, guys. Let me know what you think. Please leave me a comment down below saying if you agree, disagree, what are some other stocks you guys are looking at. With that being said, thank you guys so much for watching. My name's Jackson. Be sure to like this video and subscribe if you want to see content similar to this one. See you guys next time. Take care.